Limited Q4 and FY2025 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Mamta Nehra from MUFG Intime India Private Limited. Thank you, and over to you, ma'am.
Thank you. Good afternoon, ladies and gentlemen. I welcome you to the Q4 and FY2025 earnings call of Moneyboxx Finance Limited. To discuss this quarter's business performance, we have from the management Mr. Mayur Modi, co-founder, Mr. Deepak Agarwal, co-founder, Mr. Viral Sheth, finance controller. Before we proceed with this call, I would like to mention that some of the statements made in today's call may be forward-looking in nature and may involve risk and uncertainties. For more details, kindly refer to the investor presentation and other filings that can be found on the company's website and stock exchanges. Without further ado, I would like to hand over the call to the management for the opening comments, and then we will open the floor for Q&A. Thank you, and over to you, sir.
Mamta, nothing is audible.
Yes, sir.
You are audible.
Sir, we can hear you.
Sorry.
I can't hear Deepak's voice.
Is it audible now?
Yes, sir.
Mayur?
Yeah, it's audible now.
Can you hear? Everyone could hear. Good afternoon, everyone. This is Deepak Agarwal, and I am delighted to welcome you all to the Q4 and FY2025 earnings conference call of Moneyboxx Finance Limited. Our financial results and investor presentation have been posted on the company's website as well as the stock exchanges. I hope you all had a chance to go through them. Joining me on the call today are Mr. Mayur Modi, co-founder of Moneyboxx Finance, and Mr. Viral Sheth, our finance controller. Before we dive into the details of our performance, I would like to begin by briefly touching upon the broader economic environment. It's projected GDP to grow at 6.5% in FY26. On the agriculture front, the outlook remains optimistic. Healthy reservoir levels and a record Rabi crop harvest are expected to sustain momentum in demand. Together, these factors present a balanced and encouraging picture of India's economic journey. The Reserve Bank of India announced a 25 basis point cut in repo rate, bringing it down to 6%. This move is expected to stimulate lending and investment activity, ultimately supporting the domestic demand. I further feel that the decrease in repo rate will bode well for us in terms of reducing our cost of borrowing. Now shifting the focus to the NBFC sector. The central bank recent liquidity infusion measures and its decision to reduce risk weights for non-banking financial companies will provide boost to the sector and support credit flows. At the same time, the regulatory environment has become more stringent, emphasizing stronger compliance, governance, and risk management frameworks. These reforms are pushing all of us to raise the bar, and in doing so, we are building a more trustworthy and stronger financial ecosystem. At Moneyboxx Finance Limited, our core mission is to drive financial inclusion by serving the underserved population. Despite ongoing macroeconomic uncertainties, we remain focused on strengthening our risk management practices, increasing the share of secured lending, and reducing slippages. We have expanded our branch network, and focusing on enhancing collection efficiencies and maintaining robust credit underwriting standards, all of which are critical to ensuring sustainable growth. Now moving to financial performance of Q4 and FY25. I'm pleased to share that our AUM grew by 27% year-on-year, reaching 927 crores in FY25, up from 730 crores in FY24. Further, in FY25, we maintained a managed book of 232 crores. Madhya Pradesh is the highest contributor to our portfolio in FY25. This reflects the steady and consistent growth in our business. On disbursement front, our cumulative disbursement as of Q4 25 have reached 1,800 crores. For the full year, disbursements stood at 595 crores, marginal decrease of 11% year-on-year compared to 665 crores in FY24. As we have said earlier in our earlier earnings calls, AUM grew by 27%, but yes, definitely it is not as per our expected numbers at the beginning of the year. While we are repeating this concern, but it will bode well that, starting from the year, initially because of lesser spending due to elections by the government and, controlling the deficit, and then heat waves followed by floods in different areas, which increased delinquency levels and further which led to leading to RBI tightening the policies, especially for the unsecured lending, increasing the risk weightages, and then followed by MFIN guardrails, which really disturbed the industry and impacted the disbursements across all levels. And you will see that, which is an easier number to quote, that MFI declined by 20% in the last 9 months as an industry, from 4.5 lakh crore to 3.6 lakh crore. So, basis that 27% growth is still a reasonable number. Moving forward, our secured lending business continues to gain strong momentum. In FY25, our secured disbursement was almost double to 50%, up from 25% in FY24. Our secured loan book now represents approximately 45% of our total AUM as of Q4 FY25, compared to 24% in Q4 FY24, which is a 21% increase in the portfolio. This steady progress puts us firmly on track to reach a target of approximately 65% secured AUM by March 26, reflecting our strategic shift towards building a more resilient and lower risk portfolio. There are significant steps undertaken for secured book. Earlier, just 71 out of 163 branches were allowed to do unsecured business. This number in next few months is changing to 50. So effectively, only 30% of our old branches will be allowed to do unsecured business, and which will lead to strong portfolio shift towards the secured lending. As on March 2025, we have made significant strides in building a truly pan-India presence. Our operations now span 12 states, including an expansion into 4 new states in South India during Q2 of FY25. This growth reflects the strength and scalability of our tech-enabled phygital operating model. Our branch network has grown considerably from 100 branches in March 24 to 163 branches as of March 25. We plan to expand this further to 175 plus branches by March 2026, ensuring deeper penetration and better service delivery across regions. On the partnership front, we now have visibility of 500 crores per annum through lending collaboration, including business correspondence and co-lending model arrangements. In terms of funding, we continue to benefit from low cost and diversified sources with a lender base of 33, including 12 leading banks. Now, moving to total income, which grew strongly by 56% year-on-year, reaching 199 crores in FY25, up from 128 crores in FY24. For Q4 FY25, total income stood at 52 crores, reflecting a year-on-year growth of 23%. In FY25, our net interest income also witnessed healthy growth, rising by 60% to 136 crores compared to 85 crores in FY24. Talking about our net interest margin, they have remained at around 16.23 for this quarter. In terms of cost efficiency, our operating expenses as percentage of AUM remained at 12.8% in FY25. This includes non-cash expenses like ESOPs as well, compared to 12.7% in FY24. While our declining OpEx trajectory temporarily paused, primarily due to branch expansion and lower than expected AUM growth. As I have mentioned in earlier quarters, reducing operating expenses continues to be a key focus area for us. We are targeting to bring down our OpEx below 10% over the next 2 years, supported by growth in AUM and ongoing efficiency improvements. I would like to again emphasize here that OpEx is very much driven by the amount of AUM you have. Because, for example, every 100 crores of additional AUM, average AUM, gives you almost 12 crore of contribution to cover the OpEx. So the OpEx for this year is really impacted by the low AUM growth last year. Now coming to our profit after tax for FY25 stood at 1.25 crores as compared to 9.14 crores in FY24. It's largely driven by, one, the AUM could not grow, and almost all the operating profits were eaten up by NPA provisions. So that's what you will see, that largely an impact of movement towards NPA. In terms of returns, our return on average equity stood at 0.6%, while return on average AUM stood at 0.2%. Looking at our yields and spreads, the company yield stood at 28.13%, which is still good for FY25, and our spreads reduced to 15%, but remain at a very healthy level. The slight dip in spread reflect the rising share of secured loans, partially balanced by lower borrowing cost. In FY25, our average cost of borrowing stood at 13.1%, while the marginal cost was lower at 12.3%. In fact, for the first 9 months, we borrowed at 12%, which is at par with the best in the industry at this level of rating and AUM level. However, in Q4, we did some large NCD transactions, which made the average cost of borrowing little higher to 12.3%, but still it's on a continuous decline mode. This year-on-year decline reflects the benefits of our improved credit rating and growing scale of operations. So COP will continue to decline. During the quarter, we witnessed steady improvement in our collection performance. Our overall collection efficiency, including current and up to 30, improved to 99.4% in March 2025, which is definitely the best in the industry, up from 97.3% in December 2024. Similarly, collection efficiency for current and up to 90 days past due rose to 98.4% in March, compared to 95.2% in December, again among the best in the industry, highlighting consistent progress in our recovery efforts. That said, our credit cost as percentage of average AUM stood at 3.33% for the quarter, reflecting some pressure from the broader industry-wide stress in the unsecured segment. But as I said earlier, we are continuously improving our collection infrastructure month on month, every month, and this will show up results. This has already started showing up results, especially up to 90 bucket. But recoveries will start take some time. But as we take more and more steps every month, things are improving. Our on-book gross NPA increased to 6.61% in Q4 FY25, up from 5.6% in Q3 FY25. Similarly, our net NPA rose from 3.42% from 2.88%. Our GNPA become elevated in FY26 due to slowdown in rural economy and negligible write-offs. Our provision coverage ratio remains steady at 50%, reflecting our prudent risk management approach. I would like to mention here that as an industry-wise, when we compare to the MFI, it's including the write-off, the number is around 23 to 24%. For us, it is around 7%, including write-off. So that's kind of the difference, versus when we say that we are not an MFI. but yes, exposure to rural, hurted us this year. Now, since inception, the company has successfully raised 270 crores in equity up to March 2025. In FY25, we also achieved our highest NCD raise of 185 crores. In fact, from 23rd Feb to 23rd of March, in 1 month time, we raised about 165 crores in NCD, which is the highest ever in one single quarter, further strengthening our funding profile. Our net worth grew by 54%, reaching 261 crores as of March 25, up from 169 crores in March 24, driven by the equity fundraise during the year. Net worth will significantly improve this year as well, as 85 crores is pending from the issue of share warrants. Our debt to equity ratio stood at 2.44 times, and we maintained a healthy capital adequacy ratio of 29.25%. As we look ahead, we remain committed to building a sustainable business that leverages both technology and deeper customer insight to deliver value to all our stakeholders. We remain watchful of the fast-changing global environment and are well positioned to ensure rapid deployment of capital, scalability, and maintain cost efficiency. We will continue to uphold robust credit underwriting standards to effectively manage risk and safeguard the quality of our portfolio. Thank you. With this, we can now open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mihir Shah from Riddhi Enterprises. Please proceed.
Hello, am I audible?
Yes, Mihir.
Sir.
Yeah, thank you. Thank you, sir, for this opportunity. So, sir, my question was like, with the numbers reported this quarter, I think the investor confidence is slightly shaken, and like a lot of our assumptions have been invalidated. Like, we had assumptions in the past, like, agri and allied, dairy, and all of those will help us on the unsecured side when the cycle turns and all of that. So, could you please help us with some tangible targets on the cost-cutting front, credit costs, and growth for the upcoming quarters, so that we can continue to maintain our confidence?
Sure, Mihir. First of all, I think confidence should not be shaken. We have to compare this, with the way industry has reported numbers for this year. I think there is no doubt that last year was one of the most challenging year we have seen in recent times. This is far more, severe than even COVID waves, because it was hit at every angle, especially any lender who has some kind of rural exposure has suffered, and you would see, how the industry, I think numbers are known, how industry has shaped up. But yes, as I agree that, we still maintain a growth in AUM, but I still agree that, it is not as per anyone's expectation, and the same is true for us as well. Going forward, there are many steps which we are taking. One is obviously the shift of book towards secured, and in fact, we are today 10% of our book is now above 5 lakh kind of loans, which is where we are lending even 15 lakh, 20 lakh, with good MSME customers. So that focus is shifting. That's one part of the area. One is that building a secured book wherein asset quality can be improved. Second, it's a long-term book so that we will have a higher AUM. We can reduce cost of borrowing. Say, at every level we have scope. Right now, our average COB is 13%, although incremental is at around 12 now. So there is a scope of about minimum 3 to 3.5% reduction over the next 2-3 years. Similarly, there is significant scope in reducing the OpEx. So, once you take a deep dive, in FY21, the OpEx was 25, then 20, then 15, then 12.5. So every year OpEx is reduced. It's just a combination of largely driven by AUM. For every 100 crores you get a 12 crore kind of contribution towards your OpEx. So I think that will also play around. I agree that last year, in terms of numbers, it's a wipeout year. Although there are a lot of activities which is done. We have improved our team levels. We have improved our collection vertical, which is still improving the secured portfolio. So I think multiple steps are taken. And in terms of, as you asked about the AUM target, with lenders, we are at least targeting a 50% growth. In fact, over 50% growth in AUM for the current year. So I hope I have answered all the queries.
Sir, any guidance on the target for the credit cost and OpEx cost cutting?
OpEx, I believe it should be between 11 and 12%. It all depends on how soon we are able to grow our AUM. Our target would be to remain anywhere between 11 to 12%.
Got it. And on the credit cost?
On the credit cost, there will be, although the numbers are improving, the shift to NPA. Say, for example, 24 crores moved to NPA in last quarter, as in December quarter. For Q4, it was 18 crores. For Q1, it will again decline. So my guess is that, but given that there is some portfolio which has already moved to NPA, maybe around 3% kind of credit cost we still see for the current year.
Got it. And so my second question was that, like you mentioned, right, that the secured portfolio is much better when it comes to credit costs and other stuff. So in that case, is it right to assume that currently, like, our unsecured portfolio has completely blown up because, like, our NPA numbers are GNPA numbers are 6%, right, and 50% is secured. So roughly, like, on an unsecured front, we have a 12% NPA or something like that.
No. It's not 12% NPA. But try to understand, it's not blown up. I mean, see the situation currently that, there were sectors in the rural economy because of, the reasons I mentioned. Even if you have 2-3% kind of momency out of 100 borrowers, if, 3-4 customers go bad, right, you have a higher NPA levels. So that's what has happened. It's not that a full book has blown up. So these customers take time to repay, and then we will go legal, we will do collection measures. So the money will come. It is still coming. I mean, it's a slow process. So it's not like that everything is blown up. But yes, there are times when you have to take some changes in the portfolio level. Last year has some exceptional circumstances, and that's what you see across the board. I mean, it's not that. So any lender which had rural exposure last year got some hit. But I think the way we are seeing, the way we have given the numbers of collection efficiency, things are improving now. And these are the same. It's not that I could achieve a 99.4% collection efficiency from only secured book. So both, in fact, initial 5 years, we had 1.5% credit cost, and largely it was an unsecured book. So I think last year had some very, very pressing situations which led to this movement towards NPA. So I think take it as a one-off scenario, not something which is a consistent thing.
Got it, sir.
But yes, lessons being learned. We have significant improvement in our collection infrastructure, which I have told even in earlier earning calls, and it continues to improve every month.
Got it, sir. And sir, if you look at the numbers for last quarter, 30 DPA and this quarter, so like roughly if we negate the impact of AUM growth, then most of our 30 DPA is moving to NPA. Whereas like on the write-off front, like we are only taking 50% write-off after 90 days. So if we are not able to like get the 30 DPA collections back, can we expect that we'll get the 50% of them?
No, I think it's not moving like that. I mean, we have almost minimum 60% collection efficiency in 30 to 60 bucket. It even goes to 70%. And even now, this looks like 60 to 70% collection efficiency in 30 to 60 bucket, and in 60 to 90 bucket also. The lowest we reach is 40%, but largely it is between 50 and 60%. So that's not the case that, that anything which moves to 30 plus goes towards NPA. That's not the case.
Because sir, 8.17% of our 30 plus was of our portfolio was 30 plus last quarter, and like 6.6% is the gross NPA this quarter. So that's what I was referring to.
Yeah, but because see, there is a movement. I mean, anything which is coming, if you what the way we have to see is, there were at some point in time in December, there were like 1,600 to 1,800 cases flowing towards the next bucket. And, then it came to 1,000, then it came to 800. In March, only 450 cases moved to 30 plus, out of the 51,000 customers. So I'm saying that, you see a month-on-month reduction, and anything which is coming from back, which is already in 30, 60, 60, 90, will take some time. But that's what I'm saying, that out of the same portfolio in December quarter, we had a movement of 24 crores. In March, it was 18. So incrementally, it is coming down. So I'm sure that, once the bucket is improved at the current level, after 2-3 months, you see the impact on the NPA level. So which we have very, very significant focus, and I'm sure you will see the result in Q1 and Q2.
Okay. Thank you, sir. My last question is like,
Sorry to interrupt, Mr. Mead. We request you to join the question queue again, as we have other participants waiting for their turn.
Sure. I'll just complete this one follow-up. Like, are we looking at another no profit year, like with 24% yield and like 12% borrowing rate, 11% OPEX and 3% credit cost?
No, not like that. See, you look at it, one is that this is not 24% yield. Our yield is still at 28% plus. So it's not that even with 24% ROE, you have PF of 2.5%, and then you have multiple other sources of income. So one is that yield is at 28 point something percent today, not 24%, and borrowing cost, yes, to 12%. So it's not the case. I mean, there are other sources of income. Even this year, after so much of cost, it was not a zero profit year. You have money every time you give a 2-year to 3-year unsecured loan. It comes for a repeat year, and then you again make money on PF. You make login fees. You make multiple other fees. Even when the top up comes in secured, even then you make fee income. So it's not that the yield is not 24% in any case.
Got it, sir. Thank you so much.
Yeah.
Thank you. Ladies and gentlemen.
I would like to say here, Mamta, just to answer Neil's question. See, we are not, in terms of our teams, we are very well placed. You see any players, any large player with a 25%. So we are at 20%, but 28%, but even at a 25% yield, it's a very good yield. What you reduce as you grow, one is your cost of borrowing, which is with large player, you will have anywhere between 9 and 10, nothing more than that. So one is you reduce your cost of borrowing. You with secured portfolio maturing, you will have your OPEX at 6 to 7, 8% max. So that's the way you have to look at that. In the initial stages, you cannot compare it with the large company. in initial stages, it's a build-up stage. So what you gain is from an increase in net worth and increase in portfolio, very high level of growth. But, profit comes in later years. I mean, in terms of exceptional profits, start coming in when you cover your cost. So every 100 crore then, gives you very high profitability. Yes, please go ahead, Mamta.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. The next question is from the line of Mamta Agarwal from ABS Investments. Please proceed.
Hi, thanks for the opportunity. So my first question is, since now secured lending accounts for 45% of your AUM, which is like significantly up by 24% in the previous year. So could you elaborate on key drivers behind this? And what market signals or like internal metrics led to you prioritize secured assets? Also, it would be helpful if you can throw some light on what are your medium to long-term goals for this portfolio.
Okay, so one thing is you asked that what is driving. So the main thing is, Mamta, that we have made all the new branches. So there's the 6 new states which we entered: Gujarat, Bihar, and the 4 states in South. They do only secured business. So this is one driver where we say that we have to do only secured business. And I'm telling you that there is no single case in these 6, only one case actually in a 30+ bucket in these 6 states. So one is that we have formulated well that we want to touch upon a customer which is reasonably well off. So in terms of business, in terms of stability of business, then in terms of having a good collateral, multiple sources of income. So that's one that it's an organization drive which we are making, that even in our states like Punjab and Haryana, we are starting to raise very, very significant amount in the secured lending space. So that's what is driving. In terms of our outlook, as we have said earlier also, largely that next year target for secured is about 65%, and in 27 it would be 75% plus. So it could be around 75 to 80%, more likely 80 than 75. So that's what I've.
Okay. Great, sir. So just one more question. Given the increasing stress being observed in the unsecured lending space across the industry, so what changes have you implemented in your underwriting process to mitigate the potential delinquencies and credit losses? And has there been any changes in your borrower selection criteria, like geographic focus or product mix?
The kind of customers which now we are focusing, which are coming, because now we are even giving 15 lakh to 20 lakh kind of exposure. So there are a lot of customers which have inventory level of about 1 crore. So I think there are customers who have multiple sources of income, very stable sources of income. So that's one area wherein the customer profile is also changing. With respect to your question related to unsecured segment, I think not just this year, starting last year only, we had made some changes in our underwriting model. So we have started, taking less and less exposure in with customers who have low level of incomes. So typically, which is an MFI customer. So we are getting away from them. So that's one change which has happened.
Okay, great. Thanks a lot, sir.
Thank you.
Thank you. The next question is from the line of Sahil from MNS Associate. Please proceed.
Hello, sir. Am I audible? Yes, sir. I have a couple of questions. Sir, the livestock financing currently constitutes approximately 65% of your total AUM, making it the single largest contributor to your portfolio. Could you elaborate on whether you see this segment continuing to grow as a proportion of your overall lending mix?
I think the exposure will reduce in terms of percentage. So it will remain one of the focus areas, But, as we are growing, so, if I tell you in South, with 4 states, the cattle book is only around 20%. Again, if you see Bihar, the cattle book is very small. So one thing is that proportion will reduce. So maybe, in few years, it will come down to 50% of our portfolio. But the quality there also is improving. So although, like, in Gujarat, we have more than 90% of our portfolio is into cattle, but there are always, in each single case, there are multiple sources of income. Although we mentioned that cattle is the main portfolio, but see, we don't do any single case in cattle where there is no other source of income as well. So agri may be one other source, and especially in Gujarat, we see that there's a significant other source of income with cattle. So, people will have some shop, some other activity also. So that way, I think, and plus, we are taking many other steps also to improve this portfolio. In terms of the app, just to mention, we have made an app, AI app for cattle identification, which is a unique identification for each cattle. So this will be first in India and maybe first globally. The kind of app we are making we have already made and launched in terms of identifying cattle so that there is no repeat cattle. We found to identify any disease, the breed of the cattle, the lactation cycle of the cattle. So there are a lot we are doing to, really improve this structure. And this cattle portfolio also gives us, a lot of impact related, advantages. So like, Rabo has given us 75 crore kind of line to build this portfolio, not line as in guarantee. So first 3% loss in our cattle portfolio when the cattle number is up to 5 cattle. There's a 3% loss which is taken by Rabo Foundation. So there are multiple things happening on that direction as well.
Understood, sir.
So just to answer, yes, it will be a key portfolio, but the proportion will reduce over a period of time.
Understood. Sir, additionally, how are you assessing the current trends in rural demand, especially in the context of monsoon conditions, agricultural income, and credit appetite in your key geographies?
I think it's reasonable. I will not say that it is sharply up, but it is reasonable. The month-on-month situation is improving. So that's one part of it. But as I said, we are now very significantly in terms of incremental debt, which we are getting significantly shift towards non-agri profiles, which could be like where we are opening branches. So earlier, if we have a branch in X location, generally the funding will happen interiors in the rural areas. But now, even in those cities with people, say, having an electronic shop, having an inventory of 1 crore, we are giving them 15 lakhs. There are people with, large building material supply. There are larger manufacturers, of various things which have asset base of 3-4 crores. In terms of land and building, maybe not correct 3-4 crores, at least, in the range of 1 to 2 crores, where we are lending them, 15 to, in some cases, 20 lakhs. So that portfolio is also changing quickly. Although, yes, it doesn't show up in mass numbers, or maybe obviously it takes some time to really show up, but things are changing from that perspective.
Okay, sir. Thank you for the detailed responses. All the very best. Thanks.
Thank you.
Thank you. The next question is from the line of Harsh Shah from Sumaria Family Office. Please proceed.
Hello. Hi, am I audible?
Hi, Harsh.
Yes, sir.
Please.
Hi. Thank you for taking my question, sir. My first question was regarding the OpEx guidance that you have given. So, sir, I wanted to understand that in the last year we have added 63 branches, and in the coming
Your voice is breaking, Harsh. You said last year?
Last year we have added 63 branches.
Right.
In the coming year, our target is to add another existing branches. So,
Right.
and the OpEx guidance that you have given is between 11 to 12%. So, don't you think that is more conservative and the OpEx as a percentage of AUM should reduce more?
More conservative, as in you feel the OpEx will be higher than what we are saying? Is it that?
No. I meant the OpEx should be more lower than what you have guided on.
So Harsh, it actually depends on how soon we are able to, increase the AUM from now. So, OpEx changes with each 100 crore number. So, for example, if the way our calculation goes, if the average AUM for the current year is 1,300 crore, OpEx will be 10%. If average AUM is 1,200 crore, the OpEx will be, 11%. And then if it is 1,100, it will be 12%. So, what I'm trying to say, there's a lot of dependence on the AUM growth and AUM at a particular level. So it seems easy to say that, there is a company which has a 5,000 crore AUM has a OpEx of say 6 or 7%. But really, if you see the corporate expenses, even at lower level of say 1,000 crore AUM, you need all the function. You need a CTO, you need a compliance head senior, you need a senior credit guy. Every position, needs to be filled up, and nothing comes, at a lower price. When you go for a good guys, the pricing is same. Whether you have a 1,000 crore portfolio, whether you have a 5,000 crore portfolio, things don't change much. So, that's where I'm saying that, as AUM, it's a combination of AUM. Last year, if it were not bad, we would have reached 11% by now, even at last year level. So it's just, how soon we are able to pick up the growth level in terms of AUM.
Right. So if the maximum growth is in the second half of the year, our average AUM may be lower, and because of that,
because current AUM stands at 937 crores. So the most important thing is how soon we can grow our AUM, which will impact the OpEx level at end of the year.
Right. So,
but I'm saying you will notice that, when a company reaches 2,000 crore kind of AUM, that's where you really that, OpEx starts coming down. So everything starts falling in place. But other than that, I'm saying that, you see year on year, COB is falling, OpEx is falling. I mean, this year was an exception just because of this branch extension. Anywhere this year we are saying that we are more in a consolidation mode and, trying to optimize the AUM of the existing branches. Because see, 12 branches opening is nothing at this current level. So current year, the agenda is to, optimize on the people we have.
Right. Okay. And sir, my second question was, so assuming that we get an average yield of 27, our cost of borrowing is 12%, our OpEx is another 12%, and credit cost is 3%. So the ROA for this coming year should be negligible.
As I said earlier also, this is not a simple calculation. There are other incomes you make, there are PF, there are repeat PF, there are foreclosure charges, there are penal charges, there are bounce charges, there are a lot of other things, which impact the profitability numbers.
Okay.
Thank you.
Thank you.
The next question is from the line from SNK Ventures. Please proceed.
Hi, sir. Thank you for the opportunity. I have a couple of questions. First being, with ROE and ROA slipping to 0.6 and 0.2%, respectively in FY25, how do you plan to revive your return ratios going forward? And are there any specific financial targets in terms of ROE or ROA you aim to hit by FY26 or FY27?
So first of all, see the key is to reduce so even if this year, you see, our initial target for the credit cost was about 7 crores, which actually became 28 or 29 crores. So the largest, if that credit costs were not there, we would have made the numbers as per the guidelines, wherein we were targeting a PAT of 20 crore plus for last year, which got impacted because of very high credit cost. So one of the major areas of improvement is to stop fresh NPA. I mean, it will not stop, but to minimize to the highest extent. There will still be some write-off cost there. So one is to, at all levels, to bring down borrowing cost. It may happen that, it may decline to, incremental may decline to even 11%. I don't see complete non-possibility given, that repo is coming down, the liquidity levels will be better. But I'm saying we have to target each single sector. The OPEX is on one side. The other side is definitely your borrowing cost. And third is stopping NPA movement to the best level possible. So which is on track, and every month we are improving that. So that's one area of improvement. In terms of guidance, I think soon we should be able to share, we will internally discuss if, we have to give it to the, because, right now we cannot say because it's a listed company, we have to make it at a BSC level. But definitely the target is big and targets are good, even in terms of, so 27, I think we will have a full recovery as I see the projections. It will be 26 will be the year of recovery where, I see that, on the financials, as I already said that, 1 year got lost, but this year will be the year of recovery and 27 would look, very, very significantly better. You should see how a company profitability improves as it scales the business. It's not just true for us. For any company, you say when, it crosses 2,000 crore kind of AUM, the numbers really start, showing very different, results.
Okay, sir. Got it. My another question would be, as of March 2025, Madhya Pradesh and Rajasthan remain the highest contributors of your AUM. So given this concentration, what steps
No,
are you
not MP1.
Okay.
You have Rajasthan hardly had any contribution. Rajasthan actually AUM came down from the last year. So largely it was led by Gujarat getting almost 45 crores of AUM, Bihar, some contribution from South states, then MP and UP. So these are the main states contributing to the growth.
Okay. So what are the steps you are taking towards deeper geographical diversification?
Deeper as in within the state, you're saying?
No, the entire country.
I think at this AUM level, we are among the most diversified companies. People tell us that, at 1,000 crore, you are too diversified, which actually increases the OPEX level. So, we are in 12 states, 163 branches with, AUM of 930 odd crore. So I think geographically, we are very, very well diversified. We can obviously, once we scale up, there are 2-3 more states where we can, start our branches. But I think, Tamil Nadu, we just have 10 branches. You can have immense opportunity in Tamil Nadu. So, people are disbursing, 200, 300 crore every month there. So I think within these 12 states only, there's very large opportunity. And as I said that we are now going forward trying to capture a very different set of customers which were not doing till now. Because, as initial year, you want to have a lower tenor because you are not getting a higher tenor. You want to keep your borrowing rate also high because your cost of borrowing is high. So I think all that is now aligning on the incremental basis. So I think on diversification we are good.
Okay. So are you witnessing any stress or early warning signals in these areas, in these states particularly?
Nothing more what has already happened. So now it is only on the, how to improve these areas. I think we had faced stress in Rajasthan, in Haryana. So we have seen that. But I think from here on, we don't see any further, anything worse happening. I mean, it's on the positive side only. Yes, what has happened, and, it will have some impact on the financials. But I think nothing beyond that.
All right, sir. Thank you so much.
Thank you. The next question is from the line of Darshil from ABC Capital. You may proceed.
Hi, sir. Thank you for taking my question. I hope I'm audible. Just on the previous participant's question, actually, I also have a question on the operating expenses. So if I can just see here from the results, operating expenses as a percentage of AUM, which stood at around 12.8% in FY25, which I can see it is flat as compared to FY24. I just want to understand, this has seemed to taken a pause with the downward trajectory which was seen in the previous years. So I just want to understand what is the company doing, and could you elaborate any key reasons behind this pause in the OPEX reduction?
Okay, so I thought I have already answered that, but just to say that again, see, the expenses have increased because of new expansion in 4 new states last year, adding 63 branches, adding a lot of senior manpower. If you go to our website and see the presentations, we have now functional heads which are very senior at each function level. So I mean that has increased the cost. More importantly, the AUM has not increased. See, ultimately, you get a contribution from the AUM increase, which has not moved up. It is not that, it happened only with us. For a very large part of market, it happened that, last year was a year of slowdown, where, there was focus on collection, AUM could not increase. And this is, where you cannot lend, forcibly. So I'm saying that it's not that fundamentally something has changed. It is just that AUM did not grow in line with the amount of expansion we did. So that is why we have now, with focusing on that, with those limited, which is not limited per se, we have 2,000 people today. So, the idea is to optimize that thing and grow the AUM. With the same number of people, grow the AUM. And so, OPEX will, automatically show the result.
All right. Thank you so much for the detailed question. I have a couple of questions more. So if you can just see, we know the steady decline in both the average and marginal cost of borrowing over the past 3 years. With FY25 average cost of borrowing at around 13.1% and marginal cost of borrowing at around 12.3%. Could you just share some insights on the drivers behind this decline?
I think we'll see that companies which 1,000, 4,000, 5,000 crore AUM, they are borrowing at between 9 and 10%. So that's fundamentally as your scale of operations grow and as your credit rating improves, the pricing of loans decreases. And this is since inception in the last 6 years. First year we borrowed at 20% and now it is at 12%. So the decline will remain continue for next 3 to 4 years until you reach a stage wherein you are borrowing at around anywhere between 9 and 10. So it could be like 9.5, it could be 9.3. I mean, because you get better rates for the cattle portfolio. Because it's a SMF portfolio, once you have a better credit rating, you can get very good pricing for this portfolio. So I'm saying till it reaches, I mean, the average COB, which is 13% today, till it reaches at least 9.5%, even if, I don't get more aggressive than them, at least till it reaches, which is a 3.5% decline. The cost will continue to decline over next, say, 3 years.
Okay. Thank you so much. Another question would be on the collection efficiency. So you highlighted a steep improvement in the collection efficiency. Could you just elaborate on what specific measures or initiatives were taken during FY25 to achieve this improvement? And you also mentioned that stabilization is expected by Q1 of FY26. So what does the full stabilization look for you in terms of collection metrics? And also a last question would be, are there any particular geographies or product lines which are still facing stress issues on company level?
So I think one is, from we started building up our collection, infrastructure starting from September. We got some around 50, 60 collection officers as on date. So it has been a slow build up, but from 1st of February, we had a full telecallers platform. So each single customer gets a telecall, IVR, SMS, so which improved the collection efficiency, especially in 0 to 90 bucket. So those results have been published already. So it's a very significant jump, versus what happened last year. And I will continue to say it has been a industry-wide stress. Any balance sheet, any presentation you see, it has been an industry-wide stress, unless someone is not having a rural exposure. So that's a different ballgame altogether. Having said that, the infrastructure keeps on. In terms of 0 to 90 bucket, I believe that the stabilization is seen in Q1. So even the June quarter, I believe, will be as good as the March of last year, which is 24, when we were just doing good enough. In terms of clients which have moved to 90 plus, we are building our infrastructure, appointing collection agencies, doing all. I mean, we have a very senior resource now in collections. And, incrementally we are building, state level collection team, state heads for collection. So all that is coming up. Legal part is coming up. So everything is coming up. I think, especially, the way we see early warning signals, we have a portfolio cut of, whether these clients are paying to other customers. So there is a lot of data which we have seen. I believe that, even what has moved to NPA will have a, very decent recovery over a period of time.
Okay. Thank you so much. Thank you so much for the detailed answer.
Thank you.
Thank you. Due to time constraints, that was the last question. Thank you, management speakers, MUFG team, and everyone for joining us. On behalf of Moneyboxx Finance Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you, everyone.